Hi, everybody. This is Dan Sheridan. Today I'm going to talk about principles of managing trades by the Greeks, managing multiple positions. Could be 2 positions, 3 positions, 4 positions as one. And I think there's some principles that might be a help to you as we go through it. Like if you go to the mall with your kids, Build-A-Bear. We're going to put together 2 or 3 positions, and we'll try to just get some practice at this, managing trades by the Greeks. I was in the trading pits in Chicago. CBOE is a market maker, a specialist for 20 some years. And most of the time when you're in a trading pit, you end up taking the opposite side. Part of your job as a wholesaler, you end up taking the opposite side of the public. And so you're going to end up in multiple positions, and you couldn't manage them. You might have 50 different positions on, so you couldn't manage them separately. It'd be too much. So you just manage them as one big trade. It's like my dad used to make soup late at night, and he put everything but the kitchen sink in the soup. So it's just what's in the soup. There's a lot, but you know what? There were some principles to it, and it tasted good. Let's run through this. Just to give you a little bit before we start this, what's going on here? Where is SPX? What's going on in the market? So if you watch this video a little bit later on, as you see here, SPX is at 69.74. What does that mean? And we're looking at this as of like February 10th, 2026, early in February. What does that mean to you? Well, which you could say 42 times during the last few years, or last year, you could say we're in the upper end of the range. Well, yeah. I mean, the all-time high is around 7,000, right? So we're in the upper end of the range. And you might say, as you're going to put on some range-bound trades right now for this exercise, and these are going to be trades probably 10 to 25 days from expiration, just to give you that perspective. You can do this with shorter term than what I'm using, or even longer term. So we're near the upper end of the range. So VIX is going to be kind of in the lower end of the range. VIX is around as we speak today, VIX is around 1730. You might think, well, it should be lower, maybe 14 or 15. But, give you a last bit of perspective, the last 2 months in the market, again, this is February 2026. Last 2 months in the market, we've been choppy. A lot of choppiness, big candle days, big room between the high and the low in the day in SPX. But we've been range bound, and we've basically been 6,800 to 7,000. So you kind of have, at least as I'm looking to do this little exercise managed by the Greeks, we're in the upper end of the range. Vols are, lower than they've been. They're not low as, they've been 12 many years ago, but lower end of the range kind of right now, or a little bit higher than the lower end of the range. And we've been in this 6,800 to 7,000, right? Back and forth, a little choppy. With that perspective, some trades I might consider. So I'm going to build some trades here. And I'm in Option Omega, love their modeling tool. And so let's just say I'm just going to put 3 or 4 positions in here. But these are trades that I would consider. At 17 volatility, I do some long Vega, some short Vega. But, when you think about long Vega strategies that would benefit if volatility went up, short Vega strategies that would benefit if volatility goes down. But, the main thing you say for range-bound trades, Dan, what are you looking for? Range-bound. That's the most important factor. Right? Am I getting some type of, it's choppy, but I'm getting a range here over the last few months. So let's start this exercise, and I'm going to start with, here's 17 days out. And, and these are all trades that I would consider, right? So I'm going to clean this up a little bit. So I'll leave this up here just so we can see 69.70. So I'm going to go to, let's just start with a calendar, 17 days out. So maybe I'll do a 4 wide in the put. So 69.70, maybe go a little bit under the market, because you could still be, you'll see relatively delta neutral. So I'm going to go in there and sell. And you can see I'll do sell 5, right? And so I'm going to sell like 20 points under the market, still relatively delta neutral position. And it's something I would do. I'll go 4 days further out, and I'll buy the same strike in the puts. Here's 5. So I have a calendar on 5 times, and let's take a peek at this one. we'll look at each one, then we'll kind of build it. So here's a calendar. You can see I can kind of move it. You can see it like that. So got a calendar. Here's about $3,000 of capital for the trade. So that's what it would cost for these for these 5 calendars. And you could see the Greeks here relatively neutral, as you see, close to zero. And I have 5 contracts, so this is a $3,000 trade. Here's my gamma, which is pretty low because I'm about 17 days out, minus 0.1 or minus 0.2 just means that the deltas as we go up 5, 10, 15, 20, 30 points in SPX or down, they're not going to change much, which is good. I have positive theta. This is theoretical theta. I'm bringing in $148 on this $3,000. And Vega. Vega is just saying if the applied volatility of my long and short each go up 0.1% from where they're at, I'd make 327. If each of them goes down a point, I'd lose that. So this is the trade. And you can see as we get closer to expiration, obviously the 17-day trade generally will be in this about 30% of the duration. So if it's a 17-day calendar, that's where my shorts expire, being at about 5 days. So you can see here, again, put this on a Tuesday, Feb 10, if I go, well, even by Friday, right? 3 days into the trade, if I go towards the end of the day on Friday, there's 3:20 Eastern, you can see that green line, it's like the sun is coming up, right? So this is saying, I could be near 11%. You see the P&L there over a range here in 3 days. In 3 days, how is that possible on a 17-day calendar? Well, remember, you have some pretty good theta there, right? So 10% on a $3,000 trade would be $300. You have theta of 187. Now that's theoretical theta. It doesn't, there's actual theta which can be quite different, but it's not unusual on a 17-day trade. The most I'm looking to be in that would be 30% of the 17, about 5 days. So going from Tuesday to Friday to get 10% isn't, as Tom Jones would say, it's not unusual. All right. So now we're building a bear. We have the calendar, $3,000 trade. Shall we add to that? They say. Yes, they shall. So here's what I'm going to do. All right. I can do it from here. I could add legs, or, right, I could just add legs and do it, or I could go to the chain gang. I can go to the chain and say, all right, I like to diversify according to duration. I like to diversify. What are the ways I love you? Here, let me name the ways. All right. I like to diversify by 3 or 4 different ways. I like to diversify when I put the trades on, diversify my price risk, maybe a Monday, maybe a Wednesday, maybe a Thursday. Diversify my duration, have different durations. Well, that will help. And those are very important. So now I'm 17 days out. So let's say I'm going to add some butterflies, maybe 24 days out. So maybe I go out there and a type of a butterfly I might do would be maybe I'd call this a Sherman tank. Something I might do in this environment, like a 70-65. I'll show you what that looks like. So if we're at 69, if we're currently around 69.75, I'd go a little bit above the market, maybe 69.80, right? So 69.80, and I'm 24 days out. So I'm going to sell from the movie Trading Places, sell Mortimer. And let's just say I sell, this is one, I'm going to sell the mid strike These are range-bound trades. I'll sell, sell 6. And I'm going to go 70 points down, 69.10, and I'll buy 3. So 70 down, and then I'm going to go 65 up. So that would be 70.45. And you've got to see here, because sometimes they don't trade. You got to be careful with 5 strikes. There's no guarantee they're always going to have them. So this is a butterfly. And then I hit view chart, and okay, here is the butterfly. So I'm buying the in the money call, 69.10 calls, selling a little bit over at the money, 5 points above at the money, selling 69.80s. So there's 70 points up from in the money call to the at the money. I'm going to buy it out of the money call, 70.45. That'd be 65 points up from my short. Now, again, we're combining this with the calendar. And one thing I want to tell you, so I'll look at that and I'll see, okay, where do I want to be? Well, how do I want to drive this plane? Well, we're in the upper end of the range of the market. I want to have more room on the downside. We're 17. Maybe I want to be a little bit long Vega, possibly. We're in the lower end of the range, but I don't mind being, depending on how I get, short Vega. But I have these 2 trades. So I have a calendar and a butterfly. They're very similar graphs, but this looks more like the calendar. Why? Well, let me tell you. The one principle or thing you have to keep in mind with managing by the Greeks is the graph is going to take on the characteristics of the closer to expire trade. So the calendar is 17 days from expiration. Butterfly is 24. So you can take it to the bank. If they're similar dollar, even in the ballpark, similar dollar amounts, it's going to look like the closer expiration. That's going to be the one that would give the most attention. So the calendar is shorter term. This will look more like a calendar versus a butterfly. You with me? So you can see it's getting quite a bit there. But again, you just go and say, okay, now I'm minus 5 deltas, right? That's on the whole position. My theta has grown 220. I'm still long Vega, even though I did a butterfly, which is a little bit short Vega. But here's where I'm at, and that's not bad. Now I got my capital to 7,600, right? You with me? And so for managing it. And so maybe I go, so I have a calendar 17 days out. I have a butterfly 24 days out. And let's say I add Build-A-Bear. All right, let's go back and add one more thing. How about if I had a put credit spread, right? And so what if I go here and hit chain and say, okay, I'm still long Vega. What if I want to take get a little less long Vega, get some short Vega, and maybe lessen the deltas a little bit? I don't have to, but let's just say I do that. So now I'm going to do a put credit spread. And let's say I do, and let's just say, again, I'm making assumptions as I'm on the fly. We're near the upper end of the range. Path of least resistance is up. Let's just say for the next 3-4 days, I still think, we're moving towards the upper end of the range or whatever. So maybe I go and I look at some 10-day put credit spread, right? And maybe I go, all right, maybe on my 10-day put credit spread, I sell pick the short strike, maybe a 20 delta, sell the 68.30s, and maybe I do 2 of them. And then what I do is maybe I go to the 68.10s. So I'm going to do a 20 wide put credit spread, and I buy 2. And they're 20 wide spreads. So they're 20 wide spreads. And I'm going to do 2 of them. And it's a put credit spread. So now I hit view chart. And let's look at this. You say, Dan, you talked about your father's, when he would make some stew, when he would come home from he was a Chicago policeman. That was his way of relaxing at night. About 10 o'clock, 11 o'clock would be going to bed. he'd make soup or a stew for 2-3 hours. And he loved it. Now, the whole neighborhood could eat with him for the next week. He'd make that much. But let's look at what we've created. The monster. What do we have here? We've got a calendar trade 5 times. That's Feb 27. That's closest duration so far. And then we've got the March 6th. We've got the butterfly 3 times. That's 24 days out. That's the farthest. And then we have the closest, and we added this put credit spread. And that's going to be Feb 20. So again, when you put them all together, deltas are almost 0.3. Deltas are close to 0. I've got $11,000 of capital there. I'm using theta of 284, right? So that's about, from a theoretical, maybe 2.5% a day in P&L, right? So what does that mean? 278 theta, and I have a capital of about 10 grand there, 11 grand there. So good theta. Again, I'm still looking to get out of the trade 30% of the duration. You say, Dan, you've got a 17-day duration, which is your put credit spread. You have a 24 duration, which is your fly. And then you have a 10-day duration, 10-day duration, which is your put credit spread. 17 day duration, which is your calendar. How many days do you expect to be in? If we take this one in kind of the middle, maybe tilt it towards this a little bit, still about 5 days, right? 30%, whatever the average would be. But the thing is, there's a little bit, it's like Donnie and Marie. Remember the Osmonds? A little bit of country, a little bit rock and roll. This is a little bit put credit spread, a little bit calendar. But again, now does delta neutral mean there's no risk? No. And you can see here that this is the current price, 69.77. You could see if we move far enough, here's the result of the put credit spread. You have a little bit, their downside risk. Upside, you have less ultimate risk on the upside. But you have this wide swath of room. You can see the expiration graph of which you make money, right? That would cover us from like 7,100 on the upside. And now it'll be wider, because if you look at, as you get closer to, all right, here we are at when we start the trade, but as we go on in the trade, let's say we put these 3 trades on together. We wouldn't. In reality, would I put all these 3 trades on in one day? No, I'd separate them by a couple days, so I'm diversifying the price risk. And sometimes volatility can change within a week. If we kind of, vol goes up, then I do a short Vega piece. Vol goes down, long Vega piece. But you look at here, we're starting at Tuesday. If we go, if we just go to Friday, 4 days in the trade, if I put all these trades on today the same time, here we're 4 days in the trade at the end of the day, you can see the sun is rising, the green. So we could, this is saying theoretically, you could get up $700, right? Or $300, 6%, depending on where we're at. And that's on this capital with 5,700, right? So if we're up, at this point, 69.31, if we're down 40 points in 4 days, it says I'm up $600. $600, your maximum loss is 11. That's your capital. That's just doing a current price, like an ongoing mixing them. But your margin or your risk is your max loss, right? Because these are all spreads. So you have to put up $11,000. So just a couple, and this is just an introductory to talk about, get you thinking on Managed by the Greeks. You say, how am I picking pieces? Well, principle number 1 is volatility. I'm picking these pieces based on maybe where volatility is when I put the trade on. Number 2, am I looking at margin? Yes. Generally, I'd like to keep the pieces similar capital. In this example, each was near 3,000. Duration. I like to diversify the durations of the trade. Shorter term trades give you more positive theta, but you have more risk, right? Longer term trades will give you less theta, but more price protection. So I kind of put these pieces together. And I might, if I were to do something like this, 3 trades, put it on over a 3-day period. but I'm keeping in mind at all times the big picture. Where's the range of the price? Where's the price been over the last month or so? Why am I looking more the last month? I mean, I'm looking to be in any of these trades. Once I put a trade on, maybe 30% of the duration. So for any of the trades we do between 10 and 30 days or something like that, look at it being about a third of the time. Now, if you put if you only put 1 to 2 trades on, you say, well, I can look at them individually, yes, but it's always good look at them together, because if the market would ever go down a lot or go up a lot, hey, it's the piece, this is it. This is what she looks like. And then if I'm adding to this, this is 3 trades. If I'm adding to this, I'm looking, maybe I'm at some point, okay, I can see my downside risk, at some point I have to be concerned about it. Upside looks better, but I've got a lot of room here. I can see what piece I need for these trades. And then you're constantly taking pieces off and putting them on. So anyways, that's my thoughts for today. I appreciate it. And I'll talk to you next time. This is Dan Sheridan using the Option Omega modeling tool. Thanks.